everyone. Last month, that is the month of July 2022, saw heightened volatility in the global market. US 10-year seesawed from above 3% to finally settle at 270 by end July. Similar volatilities were seen in equities, which finally ended the month in green. Dollar strengthened, EM currencies weakened, commodities cooled off a bit. In that pack, metals and food depicted a sharper correction. US Fed raised rates by 75 basis points for a second consecutive meeting, taking the Fed funds rate to nearly 2.5%, right on top of the long-term neutral Fed funds rate. It is expected to go even higher. Policy decisions were on expected line. Refreshingly though, guidance for the near future was kept relatively vague, with emphasis on data dependency going forward. Right now, it looks like 50 basis point is probably the base case for September, but that could swing in either direction depending on how things evolve. For a more dovish rhetoric than this, the Fed needs to see compelling evidence that inflation is slowing. We haven't seen that as yet. Interestingly, bond market has scaled down its terminal Fed rate expectation to under 350, perhaps because activity data has been underwhelming market expectations of late. But the strength of US labor market and corporate profit suggests something else. Our best guess is that slowdown could be more pronounced in the second half of 2023. And on inflation front, once the commodity and supply chain impacts fall out of the US CPI, most likely in early 2023, inflation is expected to flatline around 3 to 4%. This will present the next big test for the Fed and could lead market to reassess their rate expectations. To some, it means that market volatility may continue over next couple of months. Back in India, market resonated global trends. Equity ended in sharp green month on month and bond yields fell too. We will be very careful to call out a peak in inflation. But commodities correction could help ease inflationary pressure in India too. And a lot of other macro variables could start to shine out relatively. WPI inflation could fall very rapidly to low single digit over next couple of months. Goods inflation could see a breather. CPI inflation though will be very gradual to moderate. Food, which makes a lion's share of the CPI basket, is likely to stay elevated. And we still suspect some upward pressure on wages and consequently services in the CPI basket. Unilateral strengthening of dollar has caused rupee to depreciate 6% against dollar year to date. Most currencies have weakened against the greenback. In fact, rupee is a better one amongst the EM lot. RBI has sold dollar aggressively. Just to state, FX reserves have dropped nearly $30 billion in last 2 months alone. If the recent break, which has been pulled on capital outflow in terms of FII outflow and the commodity softening persists, the monthly external account deficit could be brought under control, which could keep a lid on rupee, though we do maintain a near-term depreciating bias. Central government finances are healthy despite sudden costs it had to incur on multiple fronts due to higher commodities. That has enabled continued infrastructure spending. Broadly, domestic activity is faring well and there is a sequential demand recovery in almost most sectors. Trade cycle, which has been the mainstay of growth in last 1.5 years, could weaken now. Hence, domestic-oriented companies and sectors should start to do better going ahead. In similar vein, Q1 FY23 results so far has been better than expected in terms of top line growth due to both volume and price effect. However, cost pressures dented profitability for most companies. Financials, on the other hand, are exhibiting improving NII growth as well as PAT growth, driven by lower credit costs, even though other operational expenditures remain elevated. Reiterating our view, earnings could continue to see some downward revision, but broader outlook stays healthy owing to domestic factors. Valuations have corrected but still command premium to EM peers and domestic bond market. Thankfully, the froth in sentiments have corrected, yet near-term cautiousness on equities continue to hold. Current backdrop warrants bottom-up stock picking. In the fixed income market, RBI has delivered 90 basis points of rate hike cumulatively. But more significantly, liquidity has seen a rapid correction owing to currency pressures, which has caused RBI to sell FX and hence suck out the rupee liquidity. 50 basis point of CRR hike and the absence of any G-Sec purchases by the central bank also adds to it. Normalization in RBI policy will happen over next 6 months. We expect the policy rate to settle around 6%. We are taking tactical calls on duration, and somewhere down the line, when rate cycle matures, is when we can take a more directional view on duration. And this may most likely play out over the next 6 months. That's for this month. Signing off. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.